So yesterday we were discussing about international investment, and we said in international investment, the important, three important aspects that we talked about. One, we said that we must translate our currency into the domestic currency. If you are evaluating a project outside, then you must translate into domestic currency. Two, you must look at the tax, whether there is a double tax agreement or there is no double tax agreement. Three, we talked about the political risks associated with these investments. Then we looked at how do we translate using a purchasing power parity, using interest rate parity, and then the last one we talked about was Fisher's international effect. How do we apply the Fisher's international effect? Now, then after that, we talked about the process of evaluating a project, and we said there are two methods which are used when we're evaluating a project. The first method, we said, you are going to look at your cash flows or determine your cash flows and incorporate inflation. After incorporating inflation, you translate the cash flows into domestic currency. Then after translating the cash flow into domestic currency, you discount the cash flows using a domestic rate. That's number one. Number two, please, someone who can mute your microphone. Number two, we said, alternative, we said, determine your cash flows, discount the cash flows using a foreign discount rate. Then, after getting your NPV, translate the NPV using the spot rate. Those are the two alternative methods that we talked about, but I know some members had already reached the point of satiety. I don't know whether you still remember what we talked about. I don't know if you have a question on what we discussed yesterday. Any question before we start this example? So I want us to look at this. If you don't have a question, I think I can move on. I want us to look at this question of November 2022. Question number 3. We are not going to look at all. I have copied it all, but we may not look at it all because there's another part that we have not yet covered. Runiga Investment is a company located in Mbyo. I don't know how, in Eastern Province of Rwanda. Is there any place called Mbyo? Owned by a group of renowned investors. It is there?
Yeah, it is there.
Where exactly?
In Bugesera. In Bugesera district.
Oh, I didn't know it's there. Who are also members of Private Sector Federation. Runiga Investment has an investment opportunity in Europe. The project cost, that is our IO. This is our data. We have the IO. It's 21 million. It's in USD. It's in euro. It's in euro. It's in euro. And we are removing 3 zeros to our data. The initial investment is 21. And is able to generate cash flows. So our cash flows, year 1, year 2, and year 3. Year 1, it will generate 4.3. I've removed 3 zeros. These are in euros. They are not in This is 5.2. This is 6.3. Those are the cash flows. Then the current spot rate, our spot rate is €1 equal to 170 francs. That's the current spot rate. And the current spot is that risk-free rate in Rwanda. Our risk-free rate in Rwanda is 7.4. And in Europe, risk-free rate in Europe is 2.1%. The property discount rate, our cost of capital, is 10%. And the residual value, RV, is 13.5. So this part 2 of the question, I don't think we are going to answer it here. Also imports fish. This one is a different part of the question. Then we can answer this. Compute the NPV of Runiga investment project in Europe. Runiga investment in Europe. Now, if you look at this, that's the challenge that we may find in this question. So automatically, we are supposed to use interest rate parity to determine this, because you are given a risk-free rate. So being with the risk-free rate, automatically it means you are using an interest rate parity to determine. So how do we get our interest rate parity? We said.
Can you elaborate a little bit on that, lecturer?
Yes.
Can you elaborate on that?
Based on the data
we understand what you are saying.
Yes,
that means whenever we will find the risk-free rate,
exactly. If we are given inflation rates, we would have used a purchasing power parity. But in this case, we are given risk-free rate. These are interest rates. So it means in this case, we have to use an interest rate parity.
Okay.
Yes, that's what it means in this case.
Better you put that note.
Huh?
Help us remember.
Okay. So since we are given a risk-free rate, the forward rate can be determined using interest rate parity. I think that's what you are saying. So since you have this, you have to use an interest rate parity to determine your. So It means in this case, our forward rate will be equal to our spot rate into 1 plus IC over one plus IB. Now, if you look at this, it becomes
That is 1 or I on the denominator.
1. I didn't put 1, maybe I put it wrong. I think it's not, it is 1. Now, we have been given the spot rate. Now, which one of this? Because this is the base currency. What will be the base currency in this case? If you look at the base rate, if you look at our quotation, it is fra this, as if euro is the base. Isn't it? What, you are not saying a word.
How do you know it?
Eh? If I quote like this, what does it mean here? It means euro is the base, fra is the quoted currency.
Maybe we don't understand that concept.
Okay, we shall look at it in foreign exchange.
Okay.
So now we have these two. We have the interest rate in Rwanda and interest rate in. So what is going to be the IB? From what we discussed, this is the home country, and this is the foreign country. So it means our spot rate, if we were to put that, our FO, but now that's why we are having a challenge in this quotation. Our spot rate will be, our forward rate will be 170 into 1 plus 0. What? Is it 2175? Yes?
Why not 7?
Why not?
7 to be the home country.
7 to be the home country. And
Not to be foreign country, to be foreign country.
Huh?
You see, the company is Rwanda. It is Rwandan company.
It's another the company which want to. Huh?
Operate in Rwanda. And operate in Rwanda. You is Rwanda.
It wants to invest in it wants to invest in Europe.
In Europe.
It's a Rwandan company which want to invest in Europe. And based from what we know, that maybe from what we know, that's where the challenge is. We now need to put the practice. It automatically would have been this. But if you get this, what do you get as the spot rate at the end of the year? You are getting the forward rate at the end of the year. You are getting?
We are getting 1,112.2.3.
See that it doesn't make a sense that London franc has appreciated. That's why now we are going to change the rules.
How does it mean that he has appreciated? Or it meant he has depreciated.
Yes.
Which is correct.
Is it depreciated?
Yes.
No. No, it means, for example, currently you need to get one euro. It gives you need 1,170.
Yes.
So it means if the second part you have got to get 1 euro,
It is
1 euro.
It is 1,000.
You need 1,000.
112.
112.3.
0.3.
Notice that it means you need little
Because-
100 franc to get.
Okay, this is what you mean. Okay.
Yeah, and we said a country with the highest interest rate is the one that is depreciating.
Okay.
Yeah. What do you get? This will be the forward date at year 1, that of F1. You are getting? If you get it, please let's move fast. We have a lot of things to cover.
It's 1230.7.
12?
30.7.
Now it makes sense. Now, if you go to year 2, F2, that's what I'm going to F02. Maybe I can put F01, F02. It will be 1 to 30.7 into 1 plus 0.074 What do you get? What do you get?
And Joseph,
It's
Newton.
1294.
12 point
0.6.
If you go to year 3, forward date in year 3, it will be 1294.6
It is 1361.
Mm.
1361.8.
I think we have everything. Now, if you look at our investment appraisal or we are now analyzing. We have year 0, year 1, year 2, year 3. Our cash flows, we can copy. Year 1, it is this. Year 2 is this. Year 4, year 3, sorry, is this one. Our exchange rate, we have initial investment, our IO in year 0. Our exchange rate, this is the year 0, you take the spot rate today. So that's where we are today. 1170. Didn't copy it. 1170. Year 1, we go to this. Year 2, we go to this. Year 3, we go to this. So what will be our cash flows in FLA? We are having this times this. It will be this times this. Now, as we said, we discount these cash flows using, you're going to discount the cash flows using the domestic cost of capital. Our discounting factor, they told us it is 10%. So this is going to be 1 plus 0.1, then power minus this.
Excuse me, sir.
Yes.
What about the residual value?
Hey, there is a residual value. We forgot.
Yes.
We can put it here, which is 13.5. I think I can add a column here. Because this is my net cash flow. So I'm changing this. A present value have this times this. So my NPV will be the sum of this. So in that case, you are accepting the project. It's not very different from the normal investment approach we have seen in our previous part. The only issue that you may find here is that you need to translate your currency. That's the only issue that you may find in here. But other parts are similar. Apart from this, where you need to translate the currency, other parts are the same. And when you need to translate the currency, you need to look at which data do you have in the question. There's one I had prepared myself. Maybe I'm going to show you and see how you can handle that. I can make this one into a table. If it will even.
Question, sir.
Yes, please.
Me, I'm still having a problem on because this is the Rwandan company. So there is a bit confusion. You say that we have to look if the one which has the high risk-free rate to be considered as the interest in foreign country. So how is that working?
No, from what we discussed yesterday, we said that yes, I concur with you that Rwanda is the best country, the home country, and Europe is the foreign country. But based what we talked about is that the country with high interest rate is the one that whose currency is depreciating. So if I have, for example, the way a country with the highest interest rate is the one with its currency that is depreciating. Now we have been given a of 1.1. The interest rate in Rwanda is 7.4. Interest rate in Europe is 2.1. If you make this one to be the foreign and this one is the best, it means the Rwandan currency will be appreciating. That's what it means. The Rwandan currency will be appreciating, and in which is not correct. The Rwandan currency is depreciating because it has the highest interest rate. That's why we divided it by that. I don't know whether the principle before this is not clear.
So it means basically we have to look at the currency which is depreciating.
Yes, which is depreciating. That's why sometimes they say country C and the country B without specifying. There is this one, which I think you can do, which I had prepared myself, Similar idea. What has gone wrong? Eh, You can try this in your time. Kabode Rwanda Limited is evaluating a project to invest in Uganda. The project will require 500 million Ugandan shillings, which will be invested in assets, and 100 million will be invested in working capital, which will be recouped at the end of the year. At the end of the project, not at the end of the year, which will be recouped at the end of the project. At the end of the project. The tax allowable depreciation for asset is 25% on reducing balance. Come is not. Oh. What am I doing? As if I've deleted everything.
Click on back.
Only go back.
Click on back.
Eh?
Click
back.
on back. Yes. Yes. Yes.
My word is, why is it starting from here? It's not starting from the first line. Is it how I wrote?
Excel niko bimera.
Not easy. So this is how it is. The tax allowable depreciation is 25% on reducing balance, while corporate tax is 30% paid in the same year. We generate the same cash flows in the next 5 years. 130, these are the cash flows. The current spot rate is this, 1 FRA equal to 2.68 Ugandan shillings. The inflation rate in Uganda is 6.8, while in Rwanda 7.5. The nominal rate in Rwanda is 12. Required, evaluate the viability of the project using NPV. I think you can do that. In this case, what you need is to use the purchasing power parity. But you can as well use the second method using the international fisheries effect. If you can from this data, you can get. From this data, you can get.
Can you show us those data?
Which one?
Can you show us those data, which are indicating that we should use
because we have inflation. We have inflation. If we have inflation in Rwanda and inflation in Uganda, automatically that one tells you that you have supposed to use purchasing power parity to get the forward rate.
Okay.
Yes. But I can still use the international fisheries effect still because I have all the variables using the international fisheries effect. I can use method 2 with international fisheries effect. I think you can do this in your time. So this is you can try it with when you get time, such that it can help you to practice. So members, this is the end of investment. It has really taken us a lot of time. Investment. It has taken a lot of time, and I want to see which other small topics I can cover today. and to cover 2 topics. Why can search portfolio? We can cover portfolio, or we can cover dividend and the financial distress. Any of these 2. Maybe we can look at dividend and financial distress. Then when we meet again on Wednesday, we cover portfolio. And then still verify. I don't know how we are moving.
Why can't we go with the
mergers?
Yes.
Okay.
I think mergers is a bit big. We can do it on the next day.
Okay,
On Sunday.
Sunday.
The mergers.
Sunday is better for merger.
Yes.
Okay.
It will be better.
Okay, so we discuss.
I think even on your Wednesday we can introduce it.
Introduce mergers.
On Wednesday.
Yes,
Let's
yes,
do the small
Wednesday.
dividend and the distress today. Dividend is very small, and the distress is also not very small, not very big.
I think we should focus on those that highly asked.
So you want us to start which one?
Mergers and the finish with
No, dividend.
Dividend you can even read. So let's look at this chapter number 6, which is mergers and acquisition. Now, when it comes to mergers and acquisition, that is one way a company grow. A company can grow through mergers. A company can grow through acquisition. Mergers, it means companies are combining. 2 or more companies are combining.